putting it all together, right? And we will also see how we will be trailing the stop loss. Okay. So there are 5 types of trade. We all know. One is which gives large profit. Second is which gives small profit. Third is break even. Fourth is small loss, and fifth is large loss. Right. So once you follow the roadmap, we are making sure that you are not in the fifth category. You are not in the fifth category. Right? We are not going to make large losses in any scenario. Okay. If we follow the roadmap which I will be giving, small losses are possible because it's a learning phase and roadmap is for learning, right? So in short, if we want to learn the car or bike, what we prefer? We prefer to go in some open ground or some area where there is no traffic, right? To learn initially. That's why we'll be taking baby steps in trading in our roadmap. So even if we make the losses will be so small that they won't hamper our finances, right? Third is break even, that will be achieved, and once you reach the small profit area consistently, this is the aim for at the end of roadmap which I will be giving. It might take 3 months, 4 months, 5 months, depending on how many trades you take. So that is our aim, that we should be in profit. And once we achieve this second, then for this we can increase our capital. Right? Going ahead, we will be seeing it. So 5 reasons why traders blow up their accounts. Lack of proper education. That's not the scenario now with you people. Not using stop loss. Right? Investment is different. Don't consider this for investment. Investment is totally different. But for trading, stop loss is always desirable unless you have I will be coming in position sizing. I will explain it in a better way. Trading without plan, incorrect position size, and trading leveraged asset class without proper education. So position sizing is number of units invested in a particular stock in portfolio or trading position by an investor or trader. An investor's account size and risk-taking capacity should be taken into account when determining appropriate position size. That means position size of a person who is trading with 5 lakh capital and a person who is trading with 5 CR capital cannot be same, right? So investor or traders use position sizing to help determine how many quantity of particular stock one can purchase, which helps them to control risk and maximize return. Finding how many stocks to invest or trade is an often overlooked aspect of trading. Traders frequently take a random position size. See, what happens? Usually now we are in a group where you all people will be posting charts, right? You all people will be posting charts, and suppose you are not following the roadmap, and you have account lying 2 lakh, 3 lakh, 5 lakh in your account, and you see that one of the group members is consistently posting charts, and his follow-up charts are also coming, and they are working very good. They are giving very good profit. So ultimately our mind is human brain, so we definitely follow blindly. We try to follow that person blindly, and we invest all that amount in single trade. Whatever amount is in single trade, and it happens many times that वही चार्ट का जो ये ट्रेड है वो स्टॉप लॉस हिट करेगा. That chart only will yield the stop loss of that person. All other charts will be working. So follow the roadmap, and you should not overlook the position sizing. Position sizing should be followed. So why it is important? Drawdown of loss versus effort to get back the capital. That means if I have started trading with 50,000 capital, okay, it's no issue, as there is no loss. If I lose 5%, then my capital remaining will be 47,500. But to get back that capital, I have to make positive 5.26% of return to make this 50,000. If I lose 20%, my capital will be 40,000. To make this 40,000 to original capital of 50,000, I have to earn 25,000 return from 40,000. If I lose 50,000, the capital will be 25. To make 25,000 to 50,000, you have to earn 100%. That means you have to double your capital with your trading, right? Even if you lose 50%, if you lose 70%, you have to get your capital back. You have to earn 233%. That's why position sizing and keeping the losses in check is very important aspect. Because it's not like that जब 50 का 25 हो गए तो I'll be getting 25,000. But for that you have to double your capital. 100% return should be there on that 25,000. Then you will come at break even. Got it? So we many times take more quantity if we see the word sure short trade hai, right? Or we take less quantity if we see word risky. Many times in many groups you see risky trade. ऐसा बोला तो we don't take the trade. And if someone says sure short trade, then we tend to trade with whatever capital available is. Right? So these are not valid ways of determining the position size. If investor or trader uses random position sizing, it won't take long to lose major portion of capital. So how to determine the position size? Prerequisite for finding appropriate position size. Appropriate stop loss should be available. Account size should be known, that is capital for trading, and amount ready to lose in case of losing trade. So why do we use stop loss? We need not go with that details because we already have gone many times. Trading is a game of probability. Every trader will be wrong sometime. When a trade goes wrong, we have two options: either accept the loss and exit position, or keep holding losing position, like staying in ship which is sinking. We tend to, like examples which we have, Yes Bank, DHFL, all those were very good stocks, right? And what has happened with them? These are the recent stocks. The older ones are Reliance Capital, Reliance Communication, Suzlon, JP Associates. These were blue chips in 2007 and 2008. Nifty 50 के part भी थे वो. Right? So we tend to book profits quickly but hold on a losing trade. Stop loss acts as an insurance against losing too much. Stop is the level at which we accept that our analysis or assumption is not going to work in that particular trade. In order to use stop for our advantage, we have to know what kind of trader we are and be aware of our weaknesses and strengths. That means whether you are good at long or you are good at short, right? Whether you are bull or bear. Because it happens that certain people are more comfortable and their more buy trades will be winning, and few people will be there that their short trades will be giving them more profits than buy trades. So you have to identify yours while you go on the roadmap. The key is to find the technique that fits your trading style. Once you do, exiting failing trades should be easy. So traders should be aware that even if they use correct position size, they may lose more than pre-decided amount if stock gaps below or above their stop loss order. Gaps are usually seen when increased volatility is expected, such as before company quarterly result, corporate announcement. It's better we reduce our quantity or we can hedge it using the option. So hedging futures position with option. Hedging is to be done at time of initiation of trade and not later. Right? Buy at the money option of opposite side when IVP is, it's not IV, it's IVP, is less than 50 or IVR is less than 50. And short OTM option of same direction, preferably strike near or pre-decided target when IVR or IVP is high, more than 50. Always trade stock futures with liquid option. Means futures you have to trade only in those stocks which options are liquid. If you go and trade futures in Bosch, the options are not liquid. If you go and trade in MRF futures, the options are not liquid. So you can say you can trade in Reliance, State Bank of India, ICICI Bank, Tata Motors, Tata Steel, right? These are the few stocks. There is liquid stocks which we have to find. So suppose I want to buy Nifty futures now. Okay, 17,369 is trading. I want to buy it. So either I can hedge it with at the money option of opposite direction. So if we go options and in options dashboard, right? So if I go here and I type Nifty, so what is Nifty? IVP 18, right? IVP is 18 for Nifty. So is it low or high? Yes, it's low. So if you want to buy Nifty future, you have to buy at the money put, right? Because you are buying futures means if it goes above, you will be making profit. If it goes below, you will be making losses. Those losses will be unlimited. So how to limit those losses? You can buy at the money, so 17,300 or 17,400 put. So you can simulate it here in the option in strategy builder. We click here, we buy futures Nifty by 30th September. Add position, and I want to hedge it with 17,400 put buy, right? Add position. So what it's telling me that I'll be buying at 17,364 and 208 is 17,400 put price, right? Premium. So here the max loss is defined. So max loss is defined, that is 8,650 is the max loss here in this trade. Even if Nifty becomes zero, you will be making only 8,640 loss. So it's a predefined loss. So in payoff you can see if Nifty expires above 17,600, because these 200 points we have to add in this, then you will be making the profit. So whenever you are bullish, then only we should be looking to initiate this position, and we need not hold it till the expiry. We can square off whenever our target is reached. So suppose your target is 17,600, right? And if it reaches, the green color box which you are seeing is showing 3,110 profit and loss. That is of expiry date. But blue color box is showing 7,518 as profit. That is if Nifty on the same day goes to that level, then it will be the profit. So your profit will be somewhere between these two. So maybe you can get profit around 4,000, 5,000 rupees if it goes there and you exit in 2 to 3 days. What is the other option for me? Other option for me is to short the call. So what we have seen, I want to buy this and I will short the call. We have seen 17,400. We have to check for monthly. 30th September. So highest Y is at 17,500. TCR is 0.42. So it's strong resistance, 17,500. So other option for me is buy Nifty future and short 17,500 call to hedge. So here when you short by call shorting, the max profit is defined. That is 13,000 is maximum profit. Once it expires above 17,500, even if it goes to 18,000, you are going to get only 13,000 profit, but max loss is undefined. Right? You can see as it goes down, you will be making more losses. So max loss is not defined here. So position size calculator, suppose the account size is 1 lakh rupees and we are entering the stock at 500 rupees and stop loss is 490. So how much points is stop loss? It's 10 points stop loss, right? 490. Risk amount ready to lose in each trade is 1%. So 1% of 1 lakh. 1 lakh is your total capital. So we should not be losing more than 1% in each trade. So 1000, right? 1000 is max loss we are ready to take. So now we can calculate the position size. So risk divided by entry minus stop. So 1000 is max risk, that is 1% of our capital. If my capital is 5 lakh, then it will be 5000 max risk. And 500 minus 490, that is 10. So the quantity coming is 100. So maximum quantity we should buy is 100. We should not buy more than 100 because if our stop loss is, we are going to lose maximum 1000 rupees and not more than pre-decided risk. Clear? How to calculate position size for call cash trading, right? So if I go to our Nifty example, and 17,500 put if I buy for hedging, right? Here +1 is long in future and +1 is long in put. So we are hedging it. So what is my maximum loss? 8,640. Do you agree? Max loss is 8640. So to take this trade, what should be your capital? Based on the example which I have shown. Can anyone tell? That is your maximum risk is 8,600. Yes, it should be 8.6 lakh. If you have capital of 8.6 lakh, then you can initiate this position. Suppose I want to buy, let's reset this. Tomorrow morning I want to buy Tata Steel future. Futures buy. Okay, it's trading at 1450. So to hedge it, $14.50 is not available. I will buy 1440 put. Okay, to hedge that risk. So what is my max risk here? 46,282. Right? So what should be my capital? Yes. What is? That's why I say that do not go and venture into stock futures blindly. Right? Unless you have 46 lakhs of capital, you should not go for this. So if someone is buying some stock, okay, without any stop loss and without hedging, what is your risk? 1449 into 850 is the lot size. It's 12,31,000. So buying futures without any stop loss, your risk, max risk is 12 lakh. We won't consider, we consider that it goes 50% drop. Okay. In a rare case scenario, so 6 lakhs risk you are ready to take. What should be your capital? If you are buying a future without stop loss and without hedging. 6 CR. Okay. So if someone's portfolio is in CR, then he can think of buying futures and holding it, because we never know which stock is going to be next Yes Bank, which stock is going to be next DHFL. Do you know which stock is going to be too long? Do you have any idea? Because see, we are fortunate that we are into the longest bull market in India. We are into the longest bull market. So जो नीचे जाता है वो आखिर में ऊपर आता ही है. right? That is working at present, but it is not. You go and see if you can find somewhere Nifty 50 composition in 2007 and 8 and see what are the levels of those stocks, or Nifty 100, and see what are the level, which stocks have gone at what level. And imagine you are holding futures of those stocks without stop loss. The rollover cost, all things will be taken into consideration, you will be out of market. Right? So it's not wise to hold futures. Holding in cash equal to lot size when your portfolio is that much big. Or you are going to see, you are going to use stop loss, then it's okay. But if you are not going to use stop loss, means you are, I must have told you example of Avan Offshore. One person who was long in futures in 2007, the rate was 5,000 futures rate. He purchased at 5,000 and he said 5,000 से ही बेचूंगा मैं, right? And I don't know where is Avan Offshore trading right now. It's at 44 rupees. 44 rupees 25 paisa. Right? 5,000 का stock. It went out of FNO. उसका lot size जो भी था उसकी delivery लेनी पड़ी and he is holding at 44 rupees. Right? So this can be done when I am having unlimited capital. I am having unlimited. Suppose I am saying that my Reliance 20 shares. Right? So 20 shares is 5,000. My capital is 5 lakh. I will hold without stop loss 20 shares of Reliance. No issue. No issue with that, because 5 lakh is capital and 5,000 is 1% of that. Even if Reliance becomes zero, it's not going to hamper your finance. Right? So capital देख के we have to decide the position size. So position size depends on individual readiness to lose capital. If someone has large account size, then 1% per trade may not be feasible to lose. Means suppose we have seen example 6 CR. 6 CR is someone's portfolio, is he ready to lose 6 lakhs per trade? No, he won't be ready. So he can fix the amount, I am ready to lose 1 lakh per trade. So that much quantity he will be buying. That is for investment. If account size is too large. Position size for investor. Position sizing for long-term investors is variable and can use methods as described above, or I personally recommend to keep same amount of money invested in all stocks in portfolio. That means if you are doing the SIP, invest same amount each month in all the stocks. If market falls in panic like COVID situation or intermittent correction, you have lump sum amount of 2 lakh, 5 lakh, 10 lakh, whatever. Invest equal. Don't look for the level. This is for long term. Okay. This will help to manage the risk equally, as maximum risk in any stock will be 100% amount invested in. So if my capital is 1 lakh, let's consider 1 lakh is capital, 5,000 rupees in each stock I invest in 20 stocks. Right? Out of those 20 stocks, 6 stocks become zero. How much I have lost? 30,000 I have lost. But remaining 14 stocks have unlimited upside potential. So if I am following the proper position sizing, then I can hold it without stop loss. And if my stock selection is good. Okay. Amount invested in that stock, but maximum reward remains unlimited. Okay. So now coming to trailing stop loss. We go to trading view.